Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. I'll be talking to our head of research, Jasper Lawler, to discuss the rise in US Treasury yields, the FOMC minutes, oil prices hitting $80 per barrel, gold falling below $1,300 per ounce, and the Bank of England inflation hearings. Before that though, I'll run down some of the top corporate results to watch this week. On Tuesday, House of Fraser and Next Group report full-year earnings, while Coles and TJX report first-quarter earnings. On Wednesday, Marks & Spencer's and Severn Trent report full-year numbers, and Lowe's, Target and L Brands report earnings for the first quarter. On Thursday, TalkTalk and Tate & Lyle report full-year earnings, then GameStop, Gap and Sears report quarterly results. And finally, SSE report annual earnings on Friday. Now moving on to the economic calendar, Whit Monday means some European markets, including those in Germany and Switzerland, will be closed. Market moving data only really kicks in on Wednesday with German first quarter GDP, Eurozone manufacturing and services PMI for May. UK inflation, and in the States the focus will be on the FOMC minutes. On Thursday we have inflation hearings with the Bank of England's Mark Carney. In the early hours on Friday, it's Japanese inflation, then German IFO, the latest revision of UK first quarter GDP, and we round off the week with US durable goods orders. So Jasper, US bond yields continue to rise higher.
I know, Kelly. So they topped 3.1%. The US 10-year did. That's the one everyone's watching. So continues to move past that 3% mark, and now it's above 3.1%. It just increases the chance that 3%, it was resistance, now it becomes support. So it looks like we're going to hold above there for a while. And it makes sense in this environment, I think. The Fed are raising rates. The labour market in the US is super tight. So you expect that eventually to lead to higher wages. And probably the biggest technical issue is that the US are just issuing loads of new bonds at the moment to pay for the Trump tax plan and various budget spending measures. So obviously more bonds in the market, you just the new ones have to offer a higher rate, and so that's all part and parcel. And then when you look across the pond into Europe, you know, that's is not such a similar thing happening. So that this is a kind of concentrated move in the US.
And we've FOMC minutes this week.
Well, yes, and I think that all kind of plays into it. Obviously, when you were looking at the minutes, probably we're going to focus more on the dollar, and the dollar's obviously been rallying alongside this pickup in Treasury yields, because those Treasury yields are now, you know, the spread between those and the yields in Europe is just widening. So typically, that's what you see is, you know, when you earn a lot more on maybe 2-year bonds in the US than you do in Europe, then you see euro dollar fall. That's the relationship you expect, and that's pretty much what we're seeing right now. So I think those minutes, they're probably not going to give us anything massively new, but they will probably just confirm that most of the Fed members seem pretty confident in raising rates despite some wobbles in the market.
Okay, so oil just hit the big milestone of $80.
Yes, and so it's almost all down to the Iran nuclear deal. Obviously, the US have pulled out. Europe is still trying to string together a sort of second-rate deal without the US. But I think what markets are probably focusing on is the fact that European corporates are already pulling out of Iran. Maersk, the big Danish shipping company, Total, the French oil major, they're already getting out of Iran. So I'm sure the other corporations are going to follow suit. They obviously don't want to be hit with fines for breaking US sanction rules. So the EU is going to be left with a deal that probably isn't too attractive to Iran anyway. So unless the US and Trump return to the table, the Iran deal's dead. And so that means less oil supply coming from Iran in the foreseeable future, and you have to bake that into the oil price. So the question is, when is it fully baked in? To me, the backdrop of why oil prices are rising is because OPEC's cut supply. So you've got two forces there pretty strong, and I wouldn't be surprised to see us knock on the door of that $100 a barrel again.
Wow, amazing. And staying with commodities, but one not faring so well as oil is gold, which has now fallen below that key mark of $13 or $1,300.
Yeah, in terms of technicals, that was support for 2 months.
Yeah.
So now that I think we're significantly below 1,300, it becomes resistant. So I think it's a bit tough to get back in gold. We probably have to head lower to attract some more interest again. It all just comes down to the dollar. There's normally a few factors that drive gold. You know, it can be a safe haven, it can be an inflation hedge. It also just trades inversely to the dollar because that's what it's denominated in. At the moment, it's just that third factor. It's not acting as a safe haven. You could argue that markets have recovered a bit since the February correction. They've just been going sideways, so maybe there's not as much panic in the market, but certainly not jubilation, you would say, taking place. So it's not acting really as a haven, and inflation is still generally low across the world, so you don't need it as an inflation hedge.
Okay, fine, yeah. Now, switching gears before we wrap it up, actually, the UK inflation hearings happening this week. But you think they could be a bit livelier this time?
Yeah, well, potentially. They can be a bit dull. Obviously,
Yeah.
It's just talking about inflation. There's only so long you can handle that. But because Mark Carney and the Bank of England in general have been flip-flopping around, there's a good chance that MPs actually call him out on it. So when I say flip-flopping, obviously we'd almost 100% baked in a rate hike in May, and then with a couple of weeks to go, it completely reversed, and we didn't get that May rate hike in the end, and lots of people forecasting no rate hikes in the UK for the rest of the year. So there's an issue of communication here, so I wouldn't be surprised to see MPs try to take Mark Carney to task on it. I'm sure he can handle it, but it should be interesting to see how the Bank of England kind of justify their communication measures, and maybe it changes something if they do come under the cost too much, and we might get a bit more clarity on when that next rate rise is going to happen because they've been so unclear to date.
Okay, thanks, Jasper. And thank you all for watching. If you wish to get these videos as they're released, please follow LCG on social media.